Hello, everybody. Professor Barth here, Associate Professor at Arizona State University. Dollar report, March 2023. Lots to talk about. Of course, we'll have the inflation report later in this video. Inflation remains stubbornly high. And in fact, core CPI month over month is at its highest levels in 5 months since September of 2022. We'll get to those numbers in a little bit. But of course, SVB, the Silicon Valley Bank, collapse on Friday of last week. Got a comment on that. Of course, Silicon Valley Bank was the 16th largest bank in the United States. This is the second largest bank failure in U.S. history. And it was followed up by the failure of Signature Bank, the third largest bank failure in U.S. history. Well, you won't be surprised to learn that the Federal Reserve and foolish monetary policy is the main culprit of the current banking crisis that we see ourselves in today. You see, beginning in March of 2020, when the COVID pandemic broke out, the Fed flushed the economy with cheap credit, easy money, quantitative easing to the max. Where did that money go? Well, it went all over the place, but one of the sectors that it entered was the tech industry. And so you had all this speculation in tech, in various startup ventures. Crypto got a big boost from it too, okay? Whole lot of speculation. Well, Silicon Valley Bank, which also invested in the tech industry, of course, and many of these startups and venture capital firms, witnessed a huge inflow of cash deposits. Okay, as clients deposited loads of cash in the bank. In fact, their deposits rose more than threefold in a 2-year period, from about $60 billion to more than $200 billion at the beginning of 2022. So more than threefold increase in deposits. What did they do with that cash? Well, they invested it back into the tech industry in many cases, but they also invested in seemingly safe assets, securities like long-term Treasury bonds and mortgage-backed securities. The problem was, back in 2020 and 2021, interest rates were at zero, and so the yield on those securities was extremely low. In fact, the yield on the 10-year Treasury for a long time was under 1%. Okay, it's 3.7% now. It's bumped up to 4% in the last few months. And so they purchased these securities at very, very low yields. This was a bond bubble. So you had a tech bubble. You had a bond bubble. I spoke about this in my video a year ago on what is quantitative tightening. What are the consequences of quantitative tightening? Well, as the Fed tightens, as the Fed increases interest rates in response to the inflation that they caused, as the Fed raises interest rates, what's going to happen to the bond market? All those securities that people and institutions purchased at extremely low yields are now going to have extreme difficulty in selling those bonds on the secondary market if they are forced to liquidate those assets before maturity. Now, if you don't have to liquidate the asset before maturity, it's like whatever. But if you have to, in a fire sale, what are called fire sale losses, when there's a run on the bank, okay, and you got to liquidate your assets, and all of a sudden you're stuck with all these securities with a low yield. Meanwhile, investors in bonds can purchase on the primary market bonds at a much higher yield. Why would they purchase yours? They're only going to purchase your security at a heavy discount. And so SVB what happened? Clients over the last several months have been withdrawing deposits because as interest rates go up, people are in need of more liquidity. The tech industry hasn't done so well in the last few months. Okay, if you haven't noticed, there's been a lot of layoffs, and so with the problems in the tech industry, clients already for several months have been withdrawing deposits. And so Silicon Valley Bank had to, because this is fractional reserve banking, had to sell its assets in order to meet that demand, and that's what resulted in those huge capital losses. I saw this tweet Of course, this is fractional reserve banking. Fractional reserve banking is a classic example. This, of course, is seen from It's a Wonderful Life. I use this in my history of money class to illustrate what a bank run looks like. It's a classic scene, of course. And the tweet here adapts it for the modern age. Of course, Silicon Valley Bank was a highly woke company, as nobody was surprised to discover. But they made a foolish decision. They invested in all these securities, which, again, seemed to be safe. The problem was, as soon as the Fed raises rates, you can't unload those assets without taking on a huge loss. And it was foolish of this bank because everyone knew that the Fed was eventually going to have to raise rates. You can't keep interest rates at zero forever. I've talked a lot about this. This is the conundrum that the Fed is in right now. They've got to raise rates to stop the inflation, but if they raise rates, it's going to cause a recession. In any case, if you're trapped with these securities and you've got to unload them, you're in trouble. And Silicon Valley Bank is not the only one. And so there's real question now on what this is going to do for the banking system as a whole. Moody's, the rating firm, downgraded its outlook on the U.S. banking system to negative, from stable to negative, citing a, quote, rapidly deteriorating operating environment. Well, in comes the FDIC. Oh, by the way, before I get to this, it is interesting. It appears there may have been some foreknowledge. Top execs at SVB sold their stock just a couple weeks ago. Employees got large bonuses on Friday, hours before the bank was taken over by the government. Also, interestingly, to show how corrupt our Federal Reserve System really is, the CEO of Silicon Valley Bank also simultaneously sat on the board of directors at the San Francisco Fed, which is the second largest Federal Reserve District bank, the San Francisco Fed. The CEO of SVB sat on the board of directors. And so it does appear there has been some foreknowledge. There's a lot of speculation on the internet. Is this a scheme to centralize the banking industry? I mean, Silicon Valley Bank is a large bank, but it's not the big four. It's not the big five. And so is this an attack on medium-sized banks, relatively speaking? Will this result in, if this contagion spreads, will it result in the adoption of a CBDC? Check out my video on CBDCs for my staunch opposition to that so-called currency. I think there is an interest in CBDC adoption, of course, and if there's a major financial crisis, I do fear that the system is going to push hard for a CBDC because they know they can get that in normally. You have to have a crisis, an emergency, to justify the adoption of CBDC. And so the system wouldn't mind a good old crisis to get that through. So that there could be some foul play involved here. But it doesn't take away from the fact that Silicon Valley Bank still made stupid decisions, foolish decisions, as a result of foolish monetary policy from the Federal Reserve. Now, the Treasury is stepping in. The Treasury with the Fed is stepping in and is doing a de facto bank bailout. A bank bailout that they don't want to call bank bailout, or maybe more accurately described, a bailout of depositors. So they're saying, of course, the FDIC guarantees deposits up to $250,000. Well, if your deposit exceeded that, what happens to your money? Well, the FDIC doesn't insure it. However, that being said, under normal circumstances, if your bank fails and you had deposits exceeding $250,000, you don't lose all of that money over the $250,000. What happens as the bank's assets are divided up and everything? Depositors usually get preference, and you receive most of your deposit back. Okay, even the money exceeding $250,000, you definitely get the $250,000 from the FDIC. But then after that, above that, you still got most of it. You got about 80%. You'd have to take like a 15-20% haircut after all things were settled. That's good. Okay, that's the market. Okay, you deposit your money in a bank. It failed. Okay, now it's interesting. FDR, of all people, Of course, FDR was the president who signed the Banking Act of 1933, which created the FDIC. Got whole videos on this. Check it out. FDR initially opposed insuring deposits, citing moral hazard. He said this is a quote from FDR. Quote, "We do not wish to make the United States government liable for the mistakes and errors of individual banks and put a premium on unsound banking in the future." End quote. Put a premium on unsound banking in the future, and that's precisely what this does. Depositors should be discerning about where they put their money. You don't want to put your money in a more risky bank. If you want to put your money in a more conservative bank, or maybe you're willing to take the risk if there's a higher return. And so all this is weighed, okay? But if you eliminate, if the federal government will step in and insure, guarantee all deposits. Now, in 1933, it was up to $5,000. Today, it's up to $250,000. Then that eliminates a key market mechanism. All right? And it incentivizes risk-taking because you know you're backed up. And in 2008, they just bailed the banking system out as a whole, which taught the banks it's okay to be reckless with your money. You think if Wells Fargo or JP Morgan started going under, the federal government wouldn't bail out those banks? Obviously, they would. The precedent's been set. And so moral hazard, it's incentivizing all of this reckless behavior. Look, this is not a market economy anymore. It's not a market economy. It's been a long time since we were a market economy. We're an economy that's ruled by the discretionary monetary decisions of the Federal Reserve. Everyone's waiting with bated breath. What's the Fed going to do? What's the Fed going to do? This private banking cartel in Washington, D.C., 9 unelected directors, governors, I guess they're called, making decisions about the proper price of money and interest. I mean, give me a break. That's not a market economy, okay? It's not. Now, it's not necessarily communism or socialism either. It's this strange big government, big private corporate merger that, you always hear that quote. Mussolini said fascism is a merger of big government, big corporations. But this isn't the point. We don't have a market economy now. If we're on the precipice of some great unwinding or something, which we may be, capitalism's going to get the blame. It doesn't matter that so many of us here were just hammering away. Look what's happening. This has nothing to do with the market. Capitalism will get the blame, and then you can accept your CBDC and be grateful for it as the Federal Reserve gains control over your spending habits and all the rest. Well, you should watch my video on CBDC. We do not want CBDC. Absolutely have to avoid that at all costs. So we'll see what happens. This could be the beginning of something quite bad. Try to be hopeful, but we also don't want to be naive. The Fed's in a rock and a hard place. All bets were that the Fed was going to raise rates at the next FOMC meeting, which is next week, actually. That they're going to raise at least a quarter, and some people are forecasting 50 basis points. That's out now, okay? I mean, now there's many experts are predicting that the Fed won't even raise rates a quarter. So let's take a look at the inflation. Latest CPI numbers came out this morning. This is the 17th month in a row of year-over-year CPI 6% or higher. 17 straight months of 6% or higher year-over-year CPI. There's a graph. So zoomed out from November of 2020. So, we reached this peak of 9.1%, if my memory serves me correctly, last summer, down to 6%. Remember, the target's 2%. 2% is the target. There's still a long way to go. Powell concedes this. We'll look at his most recent statement here in a minute. This is zoomed in a little bit year-over-year CPI from November of last year. Look, we're still in deep inflation. This is zoomed in month over month. Month over month is a little more useful. CPI, February, it was 0.4%. But look, I mean, if you do the math, if you have if you have a year of 0.4% month over month inflation, you're still looking at 5% year over year CPI inflation, which is more than double what the Fed's target inflation rate is. 5% CPI would still be unacceptably high, and it just seems like we're in this rut. Can't seem to quite get out of it. And now with this banking crisis, the Fed is not going to. Let's just say they're not going to tighten aggressively, and so we're in a period now of this inflationary malaise where we just get this persistent inflation, not extremely high, but still too high, unacceptably high. And if the Fed, in response to this banking crisis, if the contagion spreads, if the Fed cuts rates, watch this shoot up, okay? Watch that shoot right back up. So we don't want to get ahead of ourselves. This is CPI month over month, zoomed out a bit. Again, unacceptably high from this vantage point. I mean, in summer and fall of 2021, it was 0.4% month over month. Okay, so we are not out of this. And then core CPI, again, core eliminates food and energy, more volatile sectors, 5.5%, extremely high year over year CPI. Look at that. Okay, core CPI year over year, 5.5%. Not out of this. And then really interesting, core CPI month over month. The forecast was 0.4%. It was 0.5%. And so it exceeded the forecast. Core CPI month over month was 0.5%, the highest in 5 months since September of 2022. You zoom out here again, inflation is still a problem, and it's coming right as this recession hits. Won't go through all the prices here, but here's the numbers. Food still rising month over month. Your food prices at the grocery store went up 0.3% over the month of February. I did like this. Look at that. Eggs were down 7% last month. Woo! Love it. we big egg consumers in my family. I love my soft-boiled eggs. I have a few of those every morning, and my kids love scrambled eggs, so we consume a couple dozen eggs probably every few days. So that egg, I like that egg price there. But everything else still stubbornly high. Energy went down a little bit. Gasoline, this number will change when we get the March numbers. Of course, everyone's noticed that your gas prices have gone up over the last couple weeks. But remember, this is for the month of February that we're talking about here. And then, won't go through all this. It is interesting. Look at used cars and trucks. Down 14%. Why? Well, because interest rates have gone up. And people have less discretionary income now, because your real wages are down. People don't have as much money in their pocket to spend on things that are not necessarily necessities. And auto loans you have to pay a higher interest rate now on your auto loan. So used cars and trucks are down almost 14% for the year. Went down 1.5% in February. Shelter is up 8%, over 8% year over year. Airline fares went up last month by more than 6%. So Powell went before Congress last week, March 7th. Got grilled there before Congress, but here's his statement. This was March 7th. Remember, this is a few days before the Silicon Valley Bank collapse, okay? So putting it in perspective, this is last Tuesday. High inflation is causing significant hardship, and we are strongly committed to returning inflation to our 2% goal. Without price stability, the economy does not work for anyone. inflationary pressures are running higher than expected. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So actually, this statement here caused many people to speculate last week that Powell would raise rates by 50 basis points, not just a quarter. Because inflation, as we saw, is remaining stubbornly high. Now you can rule that out. That's not going to happen. Okay. In fact, a 0.25% raise looks less and less likely. That meeting is next week. Then he says, in addition, we are continuing the process of significantly reducing the size of our balance sheet, quantitative tightening. Look at what that's doing to the bond market. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Yes, it is likely to be bumpy. A few days later, the second and third largest bank failure in U.S. history. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time, and the ultimate level of interest rates is likely to be higher than previously anticipated. We will stay the course until the job is done. Well, let's see. Is Powell going to... The pressure is going to be immense on Powell to cut rates. If this spreads, there's going to be major pressure on Powell to cut rates. Will he do it? I don't know. We'll see. Okay, because with rates are going to have to continue to go higher for inflation to go down. There's no question about that. Rates are not high enough for inflation to yet go down to the target level. But that's going to cause a recession. We're seeing that play out right now. So, a lot of unknowns. I'll probably make a video when we receive the report from the FOMC next week. Until then, God bless. See you next time.